So officially welcome to the Profitable Trades and Targets workshop. And this is going to be, it's one of my favorite topics because what we're really going to get into here is not just really one individual piece of the market, but really to build all the way up from core concepts all the way through how we apply those into an advanced trading strategy. And so for the advanced traders out here, some of the beginning stuff may be a bit rudimentary, but I always feel that it's important when teaching anything that that we really teach the why behind why things work and others don't, and to understand the DNA behind what strategies are the most effective versus others. And this really kind of came to focus for me when I was sitting in front of a gentleman in my office back in Vancouver, and I said to him, you know, I mean, he's trading about $500,000 in his portfolio, and I said to him, okay, well, just before we start working with each other, if we can just go through a quiz, you know, what's an ascending triangle? And he said, well, that's bullish. I said, correct. What's a rising wedge? And he said, well, that's bearish. And I said, correct. I said, well, tell me why. What makes those bullish versus bearish? And he didn't know the answer. And I think that a lot of the times when we go out to seeking education, whether it's through webinars or books or YouTube videos, we're often looking for that magic trick, that secret answer that's going to just tell us what to do. But if we don't understand the why behind things, then we're never going to be able to adapt, and our strategies will lose money. And we'll grow out, and they'll grow past us. So anyway, to get into things, quick disclaimer, obviously, we will be talking about live markets, and but it's not a recommendation to buy and sell. It's just my personal opinions, what I may be personally trading, but not a recommendation that it's appropriate for your investment strategy. Okay, so just a quick survey. Who here is not familiar with us, by the way? Who here has not heard us speak before? Who's brand new? No one? Oh, a couple of people. Okay. All right. We were founded back in 2007. I'll do this really quickly. It seems like most people here are familiar with us. But back in 2007, and we're very technically focused. The primary focus of most of our work is to, as you'll understand soon, is to have a very strong focus on technicals. Now, we believe that fundamentals do mean a great deal, but we feel it's very, very difficult to actually understand what the true fundamentals may be before it's already too late. But there are people that do, and that's the smart money. So we feel that the best way to actually understand fundamentals is to understand how to predict and to see where smart money is going and what that indicates of their opinion of the fundamentals. And to me, that's much, much more important than what opinions I might form. And through these strategies that we'll be working through tonight, that allowed us to anticipate the crash of 2008. We pulled out of the market and sold everything we were long on June 6, 2008. And we did the same thing as well in July of last year. And we actually sent out a video to everyone who registered tonight, the video from July, I think it was July 19th of last year, when we warned everyone of the reasons, the threats we saw to the market, and that we felt that within the next 3 to 4 weeks, the market was going to crash. Did anyone not have an opportunity to watch that video yet? It should have come out to everybody around about midday today. A couple people? Okay. But this is what we're great at. Now, the fundamentals of the market have been warning of a crash since another crash since 2012. But again, fundamentals have to catch up with technicals. So despite we've had these problems of China looming for a long time, it's how do we take fundamentals and time them properly, because that's what allowed us to call the crash in 08, And that's what allowed us to almost triple our corporate account since July till now, by predicting the recent drop. So you can go back and watch that if you like. There's a number of reasons which we will cover again later as to how that was a really big warning sign. But tonight is, of course, about starting to build, talk about how we can predict more moves like that and where the market's going next. So where are we at in the world? Well, right now we have manipulation from all sides. We have China devaluing the yuan. You have Japanese trying to stimulate their dollar. You have China selling off U.S. reserves and putting it into Central America. I mean, there's an amazing amount of manipulation and noise everywhere. So what is the real story? Are we at the start of another major drop, or just a small correction? We have, as I said, we have these major overseas threats. If you look at all the worldwide economies, they certainly don't reflect the strength that even with this major drop the markets recently had, you'll see that the overseas economies have done far more poorly. So what's holding it up? And of course, we have volatility at all-time highs. It is a day trader's dream right now. So if we look at the, some of the popular places where money's been going, new technologies, cloud computing, but is that market building towards the top of another bubble? And as tapering begins, what's the plan? So as we start to ask ourselves all these questions, it's really, have we learned, if we are on the brink of another 2008, what have we learned from 2008? What rules have we implemented into our trading and our strategies? And have there been any, for one? And most importantly, if there have been, are you following them? Just a quick survey of the audience. How is everyone feeling right now about the market? Are people feeling that the market's going higher? Not sure? Or that it's going to drop further? What are most people's feelings here in the group? Bearish, tentative, quite a few not sures? Lower, okay. And another quick, as we get to know each other a little bit better, and the reason I ask these questions is also so we can try and tailor the presentation tonight to the sentiment of the group and talk about, what you want to take away from today's workshop. But it seems like there is quite a strong bearish or not sure sentiment in the group. So the other thing I'd ask is what time frame are most people trading in at the moment? Are we a lot of day traders here or swing traders? A bit of both? Well, what's most people, the time frame that people are trading in? Day traders, swing traders, both? Okay. I'll tell you a bit about myself. Now, I basically am a technical analyst. So really, whether we're day trading or swing trading, I would far more accurately call myself a support and resistance trader. So if I see a stock that is approaching a major support level of let's call it $10, and there is nothing, no kind of real resistance at all between $10 and $11. Quite often I will put that trade in the night before to buy it, 10.07 with a target of 10.93. And I'll say to myself, right, I'm programming in a swing trade because I'm doing it the night before. I'm not watching it during the day. I've pre-programmed with a bracket order my entry, my stop loss, and my target. And then I'll let that go. And then on occasions that, like such as today, I'll get a ping in my email address only 3 hours into the market with my brokerage account notifying me that the trade had entered and exited already. So it's a swing trade that turned into a day trade. So what we really believe at Acorn is that that we're dealing with levels. And that's why we're talking about today is profitable trades and targets. How can we use technical analysis to not try and predict the fundamentals of where the world will be, but how can we actually get into using technical analysis to make our decisions? Most people make their decisions using news, tips from friends, things like that don't go through a quantifiable process. And that's what we're going to try and achieve today, is trying to build out the DNA of a decision-making process, so that ideally every decision we make as a trader follows the same recipe or the same types of analysis. So without that, we're only making emotional decisions. That's what usually leads to most mistakes and, of course, losses. Excuse me. And that's why 95% of investors lose money. There's a reason why the statistic is so high, because you can statistically buy or sell stocks by throwing darts, and you have a 50-50 chance of making money. So why do 95% of people lose? Because we do the wrong things, and we go against our rules. We invest emotionally and without a strategy. And again, that is why I talked about the noise earlier, is that we are absolutely flooded with it right now, and that noise is there to make us make poor decisions. So let's start getting into the technicals or how we take this down to the charting side of things. The first question I'd ask you to think about is, if you were to sit down right now and I were to ask you to take a pen or a crayon, take a pen and draw exactly what the perfect chart for you would look like. So if I told you to say, if it was to draw a chart, draw the pattern, draw the candles, draw the volume, exactly what you would want to trade tomorrow, would you know what to draw? Would you know exactly what the conditions would be? So what would the price to earnings ratio be? Would it be above 50 or below 10? Would it issue a dividend, yes or no? Would it be an ascending triangle or a rising wedge? How many people here would not know exactly what they're looking for and find that they're more kind of roaming through opportunities? Or as one book calls it, wandering through Wall Street. This is where I think most people find themselves, is that they don't know exactly what they're looking for, and so you're constantly looking at so much noise that it's impossible to have a consistent strategy, because you're getting ideas from 10 different educators, 20 different news programs. You know what I'm talking about. So people lack strategy, and of course, if you don't know where you're going, any road will take you there. Okay, so let's ask some key questions. If we're going to determine what strategy is best, or what are the most powerful trades to make, then we have to start off by asking the very basic question, which I'm sure most people realize, is who controls the market in the first place? It's not me, it's not you, it's not people. It used to be. 10 years ago, you calling your broker made volume happening. These days, it's the smart money. So 70 to 80%, and this statistic was from 4 years ago, but they estimated 4 years ago that 70 to 80% volume in the market comes from computer-driven decisions. Okay, I met a guy. I'm living in Playa del Carmen down in Mexico for the last few months. I met a bloke here, and his firm alone in North America, represents 10% of the volume in the US stock market and 5% of Canada's. Just his firm alone. That blows my mind. So that's where volume is coming from. So we have to ask ourselves then, how do they make decisions? If we go into reverse engineer then what moves the volume comes from. And the volume comes from algorithmic decision making that is based on patterns. So they're all rule driven. They're not random. They're rules that drive the market. And they control the market. In May 2010, the market plunged 1,000 points only to hit a key level straight back up. No human interaction going on in their rhythms, and that's the power that they have. And this is very important to the events going on today, because we have trillions of dollars of bubble right now, and if a bubble bursts and a vacuum is created, this is the kind of power that can happen again. But as scary as that might be, and even whether we agree with it or not, these are actually reverse engineerable. Anything that does the same thing hundreds and thousands of times over and over again can be reverse engineered, because they're following the same rules. And the first step is to understand the core ways they make the algorithms work. So firstly, the first fundamental rule that I suggested, well, that I incorporate into every single trade that I do, or everything I do with the market, is to believe that a stock or an index will only change direction because it has hit horizontal support and resistance, trend line resistance, or a moving average. So in other words, I believe that the algorithms don't see what we look at. They see this. They see levels. And understanding where so if you look at the flash crash, May 6, 2010, we came down to a core level, and that's exactly where we bounced back from in May 2010. Let's go to the live chart, and let's talk about something more something a bit more current in terms of what's going on with today's market. Okay, I'm just going to take all of these moving averages off, and we're going to go to a weekly chart of the S&P 500. Just 1 second, folks. Okay, so we're on the S&P, and I'm going to take you back to have a look at why the 2008 flash crash was so predictable, and then how that's relevant to what's going on right now, this very moment. Okay, so I've got the S&P 500. Let's have a look at the levels that existed back in 2005 and on. Now, as the market rallied for that entire period, it bounced back and forth between very easily observable levels. It was an upward channel. So the market bounced back and forth through this upward channel until when? Until it broke out right here in October 2006. That was when the channel changed. So as soon as we see one pattern end, this is where we start to look for another pattern beginning. And we get a little bit of a upward blip here. And then this is where the key, I'm just going to take that downward indicator off for a moment. This is when the key correction began. It wasn't actually 2008. The correction of the market or the crash of 2008 began actually in April 2007, when this head and shoulders began forming. And we had a left shoulder, a head, and then the right shoulder. And if we have a look at that and measure that out, there's our head and shoulder pattern. And we can then use very basic technical analysis skills simply then to measure from the head to the neckline. And I'll make that line a little bit thicker so you can see that. And simply duplicate it beneath. And that dictates us where the market is going to drop to. And that's exactly where it did drop to. Then we got, let me move that line out of the way, then we got another head and shoulder pattern. Okay, there's the left shoulder, there's the right shoulder, there's the neckline, and once again, we can take our measurement, measure from the neckline to the bottom. That's the anticipated decline. We measure from the breakout point. Okay? And this is where we ended up finding key support. We rallied, dropped beneath it, rallied up, tested it. And then what you might notice, if I flip the chart upside down, you may notice the actual head and shoulder pattern once more, which was then the bottom of the market. So when we reversed, we had an inverse head and shoulder. So, why am I bothering going back to 2008, 2009? Well, I guess one of the most important things is to firstly point out that the chaotic drop of that period wasn't chaotic at all. It was actually very well organized chaos. The market dropped from very specific levels to very specific levels that were also very easily identified by measuring just a very simple head and shoulders pattern, if you're looking for the right things. If we fast forward to today's market, let's just I'm just going to make this a little bit bigger. What can we observe that's similar? Well, we can see that the entire upward trend channel here is a similar length of time, 2012 to 2015. We've been bouncing back and forth between these very clearly defined levels, and then we broke it right here in August. Now, for those of you who did get a chance to watch the video, this is when we published our prediction that the market was about to crash. And here was the pattern that we were hoping would follow. Well, hoping because we've been short since then. And as you may notice, we're getting a very similar type of scenario as we did back in 2008. We're getting a head and shoulder pattern that we're right at the neckline of currently right now. So what does that mean going forward? Well, that would mean a potential drop down to, well, we'll do that from that level, looking basically at a 1600 potential target. Now, if we expand that a little bit further and we look at our other technical analysis rules, we can look at our Fibonacci retracements. Okay, so from the 2011 low, that last big leg, that would be a 50% retracement. Okay, so that coincides freakishly. Let's go back a little bit further. Let's go all the way back to the 2008 lows, where the entire recovery to possibly the top, and you'll see the 38.2% Fibonacci right at that level as well. If we delete that and go now into one of the most, the recent measurable move, which is from peak to reversal point. So when we use our Fibonacci extension, we go from the peak to the major reversal point, so from top to bottom, and then we do an extension from there, and you'll actually see that our 100% Fibonacci is exactly 1600. So we have three levels. We have the head and shoulder confirming this serious negative sentiment, and then we have all three types of measurable Fibonacci's all lining up at the exact same place. So this is where we start to see 1600 as a major, as a very likely magnet, if you will, driving the market down. So, so long story short, I guess what I'm trying to get across, why I talk about the difference being swing trader or a day trader or a long-term investor, no matter what time frame we're looking at, the market moves. I believe the market moves within very clearly identifiable levels. And the real trick is to understand, as a trader, where those levels are. The next step, of course, is then to understand when we reach those levels, are we likely to break them, or are we likely to reverse straight back down sharply off them? And that's where we're going to tie in with the smart money. But just let me check in with everyone. Is everything I've said so far make sense? Can everyone see the patterns and so forth and the support and resistance I've been pointing out so far? Terrific. Okay. So we're always looking for correlation. We're looking for, we're not, and again, you'll keep hearing me saying this, Matt, I hope not too repetitively. I don't care what I think. My opinion is only mine. But what I care about is being able to have a list of rules that tell me what to do. If I have to think about what to do, I'm going to be going to bed stressed every night, wondering if something's going to gap up or down, or whether I made the right decision. Did I put too much money in? Should have I bought options that were a little less out the money? If you're constantly making your investment decisions, how do I put it? If you're constantly making the decision in a new way every single day with every single trade, you are going to stress yourself into an early grave. Because if you don't have a set of rules to live by, you're going to be constantly looking at ever-changing variables with no lockstep methodology. For me, I never worry about whether I'm right or wrong. What I worry about is, has the trade met my rules? And that's the question. What's my estimate for when the market will crash down to 1600? Okay, we're going to get to that. And we're approaching some very, very important days that will determine that. Let's start to look at how we firstly define support and resistance, or what the strong support and resistance levels are, just so we can lay one more level of technical knowledge onto the plate before we start getting into the more advanced stuff. So firstly, the first thing to understand about predicting market direction and of course scanning for the most highly profitable pattern, which is what we want to get to in the end here tonight, is understanding market structure. Now, there are three types of patterns in the market, three groups, I should say. There are oscillating patterns, there is momentum patterns, and there are consolidation patterns, which really are a subgroup of oscillation. So firstly, the very first thing that you do whenever you're looking at a market or a stock, if you want to be able to trade it, we need to know where the strongest support and resistance is. So if does anyone not know the difference between an oscillating stock and a momentum stock? Oops, excuse me. Does anyone not know the difference, or is everyone already quite familiar with that concept? Okay. So I'll do a 2-second quick explanation. Oscillation is where a stock goes back and forth between static lines. In other words, straight lines. So if you're dealing with an oscillating stock, you're likely dealing with a pattern that looks like this, where a stock might bounce back and forth between two straight lines. If you get that pattern, it's likely to break out to a 67% probability, whatever the distance is of that triangle at the beginning. So you have an oscillating pattern followed by a breakout. There's many other iterations which we can get to later, but if you have a moment, so in other words, if you have oscillation, the most important support and resistance are the straight lines around the stock. that kind of contain the movement. Whereas if you're dealing with a momentum stock, the most important thing are the moving averages. And that's what the stock will actually keep respecting, is it'll keep rallying up there, usually until it meets the next moving average. And that's the most important test. So it's really, really important to understand whether you're dealing with an oscillating stock or a momentum stock, because otherwise you don't know what the most important support and resistance to look for would be, which means you don't know if it's a momentum stock and we run into an oscillation level, we don't worry, because momentum trumps oscillation if it's a momentum stock. So we hold and it breaks through. If we're dealing with an oscillating stock and we hit resistance, we sell, because oscillation trumps oscillation. And if we truly believe it's going to go higher, we simply buy back on the other side of the line. Okay, so we will go through examples. There's plenty of them. And but let's first talk about oscillation. Oscillating stocks are, if we're looking at an example, we're trying to find the most important powerful level. So if we see a stock is bouncing back and forth, let's have a look, for example. We'll go to let's go to I'll go to a 5-minute chart of NUGT. It doesn't matter what time frame we look at, because we're simply looking at movement. Now, if you look at NUGT, which is the triple on the gold miners ETF, and you look at this chart right now, tell me, does this look like a momentum stock towards the end of the chart, or does it look like oscillation? Okay, yep, a few different guesses coming in. Pretty much a split group. Okay, here's the way you can tell. If the stock is momentum, it will listen to the moving averages. So there's the 9. Oops, let's add that properly. Okay. Oh yes, that is correct. With the exponential 5-minute. All right, great. Let's add the 20. Oh, right. Anyway, this time we can use the 9. Okay, so if the stock is listening to the moving averages, then it should basically go. It should ride the moving average. And the 5 minutes is a bit too short term to tell, but basically this is going to be an oscillation trade. And without looking at the moving average, we'll see that on other examples. The reason is because if we were to say what is controlling this stock, what is making it go up and what is making it go down, it's not a moving average. If we look at the way this stock is forming, we can almost perfectly draw 2 straight lines that the stock never gets above, never gets below, but at almost every single turning point, it always touches it. That's your first telltale sign that you're dealing with oscillation. And therefore, once we know what support and resistance is most important, what does that allow us to do? Once we know what support and resistance is, then we know what type of pattern it is. So essentially, when we're identifying a pattern, all we're really doing is we're looking at the chart like a kid's coloring in book, like someone's coloring in between the lines. And what we need to know is where those lines are and what shape does it make when we draw them in. And when we go here to this stock and we take the stock off the chart, what pattern are we left with? This is a pattern, yep, exactly. We're dealing with a rising wedge, which is bearish. So if you were trading this type of a stock, By identifying that it's a oscillating pattern, you then know what support and resistance to look for, and then we're able to identify that this would be a bearish pattern. So this, for example, may be something that I would then go in, and if I was day trading that, I'd go in and say buy some $56 puts that expired next week. This is exactly what I've been doing, by the way, with NUGT. We've been trading this now for 2 weeks. This is one of the other videos we sent you. We bought $50 call, $45 calls on NUGT when it was back at 25 a couple of weeks ago. That expired in March. And it was all based on this type of pattern recognition. So the pattern tells us that NUGT should drop tomorrow. How much? Well, we measure the distance of the triangle, and we see that the drop should be basically just a little bit below 55. I've actually measured that wrong, incorrectly, I should say. There we go. So the drop should be just, basically the same level, so about 54.60 or so. We did, yes, it was a great run, one of our best trades this month. So that would mean that the market should push higher. Okay, so now let's go back. So that's what oscillation is, though, and I've used that as a 5-minute example simply because it's the one that's freshest in my memory. Okay, let's now look at a momentum pattern. Now, when we're dealing with momentum, it's not the static lines that are most important. In fact, the reason why we bought $40 or $45 calls on NUGT is because we saw momentum occurring. So let me just take all these other little lines off the chart. What you can see here as NUGT went flat, you can see that basically these moving averages didn't mean jack, did they? Look at the moving averages. Did they help the stock stay up? No. Did they hold the stock down? No. The moving averages did nothing for it. They didn't mean anything at all. And that was an oscillation or consolidation pattern. Okay. Then all of a sudden, we saw the pattern shift. We started to see that all of a sudden the moving averages did start to matter. And the stock kept on bouncing below it and never crossing above it until finally it did, right here on January 26th. And on the day that it did, we ask ourselves, okay, well, we don't have enough history yet to really know if it's truly changed into momentum. Has that moving average really become the most important thing? In other words, is that the most important resistance to this stock? Because if it's just overcome the most important resistance, then we should be buying it, shouldn't we? Okay, well, how do we know that? How do we know if vital resistance has been broken? Anyone? Yep, Rich, you're right. Okay, the answer is volume. So when we go and have a look at the volume, what you can see here is that as we challenge resistance, the stock traded 6.8 million shares. As it broke that level, it almost doubled to 10.8 million. That's the way we tell when key resistance has been broken, is when we suddenly get a burst, and of course where the stock closes at the top of its range. That was then confirmed by the fact that the stock, after breaking it, didn't break back below, not even once, not even on its intraday lows. And that told us that all of this resistance that we may have been worried about didn't really matter anymore, because now we had a momentum trade, a momentum pattern. And in fact, this pattern that we have on the chart is called a fallen angel. It's where you get a handle, or some other people call it a frying pan, where you get a channel of oscillation that then turns into a spoon. You get a nice rounded bottom, or a bump and run is another term for it. So you get oscillation, then a nice little spoon at the bottom, and that's where you get in. And then they just go. And because we know the pattern, that gave us the confidence to hold all the way up until when it hit the moving average up here at the top, which was the most important resistance to this trade. And that's where we got out. Okay. Why 45 calls and not 25? We had a few different. There was a number of ways we were playing the gold move. Because NUGT is so extremely volatile, I had high confidence that it was going to get up. I didn't need it to get past 45. I never intended to necessarily trade to take delivery of the stock. So whether it was in the money or out of the money didn't really matter. What I was looking for was the contract that was going to have that was going to increase the most value, even if it only got to 40. The contracts of the 45 calls were going to go up a lot more than the $45 calls would go up more than the $35 calls because of how far out of the money and how cheap they were. Therefore, how much they could increase the closer the stock got to the strike price. So really just trading emotion, not actually really caring what price the stock got to before I got out because it was just so liquid. Okay. So that's the difference between oscillation and momentum and how we've applied it in the long-term trade for NUGT and what it's indicating in the short-term trade based on the 5-minute chart. Does that make sense to everybody? Any questions on that one? Ida, if you trade futures, you're going to love what we're getting to next. Okay, so I'm going to kind of fast forward through some of this stuff because we're already jumping into the advanced topics already. So basically, if you identify that a stock is oscillating, then the key thing you have to look at is where are the most powerful oscillation levels. The rules here is to look at a couple things. So let's say that a stock is dropping. It's dropped from $30 to $25, $20, and you're trying to time when you're going to buy that. You need to know where is the most important support. So the few most important rules with oscillation is you want to find where the powerful level is at. So how do we define power? You want to look back on a chart, and the first thing you want to look for is where has the smart money bought in. So what we want to see is that a stock has been dropping, trading 40, 50, $60 million a day, or maybe a lot more. And all of a sudden, it's hit a certain price and gone straight back up. Okay? Straight back up. So, kind of like a 100-ton truck going down a highway at 100 miles an hour, coming to a complete stop, turning around instantly, and going back the exact same speed at the exact same time. That would take an incredible amount of power. So what I'm trying to get to is that's the power that has to happen if a stock like that's going to simply turn around and go straight back up. The only way that amount of power can happen is if the 80% of volume that is high-frequency trading says buy. Right then. The light goes from red to green and it shoots up. That's how you trade an oscillating stock. You don't wait for it to turn around. You buy it. You look for that exact level where it turned last time. So that's the first thing. We want a sharp, powerful drop that instantly turns into a sharp, powerful rally. Now the next thing we need to consider is how many times it's touched. So just a quick survey of the audience, where would you, if you saw this happening, where would you feel most comfortable buying? The first time it touches that support again, the second, or the third? What would you wait for? If you were to trade that stock and you saw that stock shoot up, let's say that's from 10 to 20, would you buy it the first time it did it again, second or third? Where would you feel most comfortable? Yep, exactly. Yep. This question always gets people divided. Okay. So this is why we come back to why 95% of people will lose. And this comes back to another one of the second rules that I talked about. The first rule I said was that the market will always and only change direction because it hits support or resistance. And we just have to figure out which is the most important. The second is the rule of three. When we're dealing with an oscillating stock, every time that support is tested, it becomes more obvious to everybody else. Now, the more obvious something becomes to the public, the less likely it will be to happen. Now, you're an educated group of traders, so it's an unfair sample size to use. But if I could go out and ask 1,000 investors what they would think, where they think the market's going next, I would 100% of the time do exactly the opposite of what everyone said, the majority of people said, because that's why 95% of people lose. Now, with an oscillating stock, the more times it touches, the more comfortable the everyday person feels at buying, because it looks like that support has proven itself again and again and again. And by the third time, they're feeling so confident that that's when they jump in. But the more times it touches, the weaker that support becomes. So the actual perfect time to buy is right here. I'll still trade it here, but then after that rule of 3 touches, that's actually now a short. That's actually now where I'd be looking to short the stock as it breaks down. Exactly, Ida. Yep. The rule of 3. Now you will see this again and again and again. You'll see this on the descending triangle patterns. You'll see them go 1, 2, 3, break. You'll see them on ascending triangles, ascending channels. You'll see it go 1 touch, 2 touch, 3 touch, break. You'll see it everywhere. In fact, head and shoulders. 1 touch, 2 touch, 3 touch, break. The rule of 3. All of those that I just described are oscillating patterns. Okay. And the final thing to consider in oscillation, I'm going to skip some of these slides for the sake of time. The final thing that we want to then consider is how it reverses. So if we're dealing with an oscillating stock, and we're looking to, and we see 2 stocks that we're considering shorting, stock A and stock B, which stock do we want to short? Which is the highest probability? Yep, everyone's got it right so far. Exactly. Oh, hi, Ed. How you doing? Good to see you. B, exactly. So, and the reason why is because we're looking for the power of a level. If we're dealing with oscillation, oscillation doesn't take time to make decisions. It doesn't think about it for a while. That's retail. That's hedge funds or mutual funds. That's investment. And that's why if you see this stock, it's a soft support, a soft resistance, where a stock will then continue higher generally. What we're looking for is that trigger, that simply the lights went off and it went from buying straight away to selling. We want that instant, furious, aggressive reaction. And so when we start to see the sharp top, that's why that's the better short. Now, Of course, where we're driving to here is we keep referencing patterns. And this is why a lot of people don't know the difference between improbable double tops and very effective double tops. So for example, if you're looking at a double top and it has a rounded top like that, that's actually called an Eve and Eve double top. You also get Eve and Adam double tops. You get Adam and Eve double tops, and you get Adam and Adam double tops. So when people say, I say, well, what kind of chart would you draw? Well, if you could take a pen, what exactly would it look like? And someone draws me a double top. Well, hang on, but what kind of double top? Is it an Eve and Adam, and Adam and Adam, and Adam and Eve? Each of these have very, very different probabilities. And obviously you don't want to trade the bad ones. The highest probability double top is an Adam and Adam double top with a slightly lower high. That's the highest probability based on the things we're talking about, oscillation. So if we know this is the best, why would we ever touch anything else? Anyone want to throw a guess why we'd bother touching any of these other patterns? It doesn't matter, and it doesn't matter what time frame. If you're dealing with a 5-minute time frame, then you're trading a 5-minute trade. So you wouldn't take the 5-minute chart and apply it to a 5-day trade. So every time frame and every pattern is meaningful if you're trading within that time frame. Impatience, yep, exactly. Impatience is one. Impatience because they have to trade that stock. They don't care that it's only a 50 out of 100 in terms of the highest ranking profitable trades. Maybe it's only a 50 out of 100, but hey, it's the stock that I like. And I spent all this time researching it, so to hell with it, I'm going to take it anyway. That's not a good trade. And why do we do that? We do that because we don't know what else to trade. Sure, if we could have D, Adam and Adam every single time, we do it. But because we don't know how to find that, we compromise on quality. Okay, so let's move along. So this is ultimately the checklist for an oscillating trade. Now, as we get into live examples, we're going to find all these signals and all these types of patterns come out. But that's the most important thing. Determine, is it oscillating or momentum? If it's oscillating, where is support and resistance? What pattern does that make? And are we trading a high probability zone? Once we've got all of that kind of cool stuff done, that is, you can trade with only that. Before you add any other indicators and any magical powers to your trading strategy, if you just can identify where the most powerful support and resistance is and identify what pattern it makes, and then know the rules of how to trade that pattern, you're 99% of the way. Everything else is all about, like the indicators and so forth, volume, is all extra stuff. But that's what we use to confirm the trade once we know what the trade is. All right, let's move on. Obviously, as we start to talk about the fact that there are, I made mention of this before, that there are close to 100 patterns out there. We just talked about 4 of them, the 4 different types of double tops. That's 4 different patterns. So that just make up double tops. There's also the same amount in double bottoms. There's triple tops. So you can see how the number easily gets up there. The key thing that we want to do is I'm not professing to you that you should go out there and learn every pattern. But what I'm suggesting is that as a trader, let's focus on trading the highest probability patterns, knowing exactly how we identify those and then the rules to trade it. And focus purely on the highest probability patterns that are out there versus the versus just trading, finding the best trade we can on what stock's in front of us at the time. Okay, so now I want to talk about smart money. And then we will get into scanning. So we were going a little bit over time, but I hope people are finding it worthwhile. Again, you can see that I'm not here just to kind of teach you one little trick. I want people to understand what took me the better part of the last 14 years to learn is why and how things work, so we can get a really focused plan together. Because once we start to understand these concepts, now we start to incorporate the fun stuff, which to me is the smart money. Okay, so let's go back to the S&P 500, and then we'll talk about smart money, and then we're going to go into the scan stuff, which is the how we make this all tick. So let's go back to the S&P 500. And let's go back to the current market conditions, of course, on top of everyone's mind, or the forefront of everyone's mind. And again, we'll start with the weekly chart. So very quickly, ladies and gentlemen, oh, by the way, I'm going to talk about the rule of 3. 1, 2, 3, break. Anyway, what's the definition of an uptrend? What's the technical definition of an uptrend? Higher highs and higher lows, exactly. Okay. Now that might be true in its simplest form, but that's exactly how the market manipulates people. If you see a stock going up and it's making higher highs and higher lows, but with a contracting range, that's bearish. We just talked about that with NUGT. If we see a stock that's going making higher highs and higher lows, but it's closing lower and lower and lower in its range, that's also bearish. If we see that it's doing that on decreasing volume, now that's even more bearish. Now we have a contracting range with lower closes, with decreasing volume. Hey, we've just drawn ourselves the perfect short. Right? We've just drawn ourselves the perfect short. And in fact, if you want to look at one of those that we just shorted recently, this is actually one of the ones in your and we're still holding, in fact. This is one of the ones right here. ALNY, pharmaceuticals. You can see that same thing, rising, making lower highs, making it contracting in range. As we go up in the volume is dropping and dropping and dropping, and then boom, straight through. Anyway, and we bought, was it $75 puts? And we're still holding those. They're up about 6, 7, maybe even 800% at the moment, based on that type of strategy. Let's go back to the S&P 500. So the S&P, what I was trying to get to was that we have to look deeper in terms of the price action. We have to look at where the stock, where it closes. We have to look at where the volume's going. And we have to look at the highs and lows as well. Now, it's only if all of that's happening at once that we have a true uptrend, that the smart money is behind us. So we want higher closes, so higher highs and higher lows, closes higher and higher in the range, and volume to be increasing. And if you want to add one more extra, if we can find it, an expanding range as well. Okay, now if all of that is happening, this little indicator down the bottom will be going up. And this is what we use for a very key smart money indication. And because it looks at all of that and says, is the stock going higher, or is there actually an uptrend there as well? And what you can see is that the very day that the upward channel was broken, do you notice that that was the very last day that the smart money made a high. Do you notice that ever since that very day, it began to go the opposite way of the market? Now, that is the beauty of divergence. When we start to see that the price is going one way, but the smart money is going the other way, we have entered the scary zone. Now, when the chart patterns then tell us the same exact thing, now we no longer have to start asking ourselves, are we right or wrong? But what if Obama, releases this? And what if the Fed starts to do that? What if this goes on? Hang on, my next door neighbor, he's a good trader, and I mean, he's buying lots of stuff with his mutual funds right now. I mean, you could send yourself nuts. What we look at is when we start to see these things happening, and then we see the bearish pattern occur, we say, to hell with all of that. The rules tell us to short, and we short. And again, right now, what do you actually see has been happening with our smart money indicator ever since the middle of 2014? Do you see the same pattern? Bank of America Merrill Lynch just released a report last week that currently we've just finished the longest consecutive week by week by week by week streak of exodus from equity funds since 2008. The longest streak of redemptions of equity funds that we've had since 2008, right before we crashed, is happening now. So are the patterns. So when we start to look at those rules, money flow is the last very key important thing that I wanted to share with you as we start to put all of this together into one big picture. So what does all this mean? Well, firstly, before we move on, any questions on that? Can everyone see how this is all kind of coming together? Yeah, now there are outflows in spring, but we're seeing, the only time we've seen outflows of this level was 2008, according to Bank of America Merrill Lynch. Okay, so how do we put this all together? What are we ultimately looking for? What we're looking for is we want to see where probability takes us, and having the set of rules. So the things that we want to determine is we want to say, firstly, not is the market bullish or bearish. That's not the right question to ask, because that's subjective. The question we ask is, are we at resistance or are we at support? What support and resistance is most important obviously needs to be answered first. And are we at that level or are we above it? Below it or above it, I should say. Okay, so if we're at it, is the money flow telling us that the move is going to continue, or is the smart money showing us that it's going to end? So essentially we are looking for that answer. Is the market favoring longs or shorts? Now we are at resistance. So once we know where the market's at, and then we can say, okay, well, is the market in a momentum or an oscillation pattern? Well, right now we're in an oscillation pattern. But this tells us that that currently there is an advantage to the short side on the weekly chart. On the daily, we may still have a little bit more upside. We have to find out. But I want to share with you now something that I'm sure very few people in this room may have heard about. Maybe some of you have. But there is one other technique that we use that is not based on price to determine to close to 80% probability where the S&P 500 will go next, based on a support and resistance not set by price. Does anyone know what that's called? Yes, some of the Acorn students in here definitely know. I know you know, Ed. Yep. Yep. Vince, you got it? It's open range. So there's 2 days of every month that are the most important days for the S&P 500 above all. And if you look at if you go back 2 years and look at the first trading day of every month, and if you look at the first trading day of every month, we'll look at the most recent here. Let's just bring up a new project. Okay. Okay, so let's go to February 1st. There we go. February 1st. What you do is you look at the range from the top to the bottom and whatever the range is of that first day of the month tells us what open range is, the opening range of the S&P 500 for the month. Now, what we're looking for next to determine to over 80% probability, based on looking back over the last 2 years, is do we close more than 3 points higher or lower than that range? And if we do, that tells us that where the market should immediately go to, negatively or positively, and basically that will remain that sentiment until the next open range day. Excuse me. So as you can see here in February, we broke negative, and that was a perfect time then to tack on shorts, or when it rallied back up into resistance, to tack on shorts. That then continued all the way to the bottom, where we got down to our oscillation level, where we saw that very strong reversal here from back in January 20th. A few other things about that price, but anyway, we rallied back up. So yeah, we hit that. And then the next open range day is options expiration, which was actually last week on the 19th. So basically what open range does then is it resets. So it doesn't, open range doesn't tell us that the market's going to never go up. It tells us that when that range is set, if it breaks negatively, it should close within or below that range, but it's got a very heavy negative sentiment. So in other words, you could simply go and sell 1960 calls, for example. That's what this strategy is telling you. It's telling you that it won't get up there. It should stay at the top of that range or below it by the next open range day. And most of the time it continues. So now we've got open range on Friday. Open range has been now set. We broke above it on Monday, which means that the sentiment is now positive until the next open range day. So we should close above 1900 at least, and quite possibly above 1920 with a very positive bias at the moment before the next by the next open range day, which is when? The next open range day is the 1st of March. So we have 1, 2, 3 more days left of positive bias. Okay, so what my prediction is that over the next little bit we'll oscillate back and forth between this kind of 1950 level and 1900 until the 1st of March. And my hope is that what we basically have for next open range is a nice kind of bearish candle, a bit like that, and then the next day we break below it, and that gives us 3 full weeks in March for us now to continue down into our next part of the head and shoulders pattern towards 1600. That's what we're, and now if you look at the gold versus the market, you'll know that there's quite a lot of obviously correlation. March is also traditionally very bad for gold. So this all kind of works nicely into the timing that we're looking for a March breakdown. Now, if open range breaks positively, then we're going to be looking for longs. But basically, depending on whether the market breaks higher or lower than the 1st of March is one of the most important things that we'll look at as to whether we're going to go and run our scans hunting out the smoking longs or the smoking shorts. Okay. And if you look back, right back in August 1st, where are we? There we were. Sorry. There was our first trading day of August. I told you we were predicting the crash at the end of July. In August, we broke open range to the downside. And then after we broke through there, and then the next open range day was Friday, August 21st. That just really confirmed it. But that was the big telltale sign. So, let's bring this full circle. So what can we do then to really take this and then go make money? Well, the key is now, I've talked to you a lot about the market. I've talked about market structure, basically the difference between oscillation and momentum. We've talked about predicting levels of where the most powerful places are, and talked about predicting the S&P. So we can look at how do we predict where the most important levels are for stocks. How do we know how can we start to identify powerful patterns? And then also taking it right back to the market, how can we identify what the macro market looks like, where it's going to go for the next 3 weeks, and the 2 most important days there. So what we've now been able to do is we're starting to get a checklist together of how we can go about and make a trade. So come March 2nd or 3rd, I'll know whether I'm looking for lots of longs or lots of shorts. Some of the stocks that we've traded recently, with the ones we've been emailing out, just to give you a bit of an idea. So based on the strategies I've just talked to you about, we'll then go run our scans. So, an easy way to go about running scans is you can use something like FinViz. I'm going to show you some more advanced ways, but talk to you about some of these more advanced ways here. Let's go to okay. So, let's say that the market breaks bearishly. What you can go into is you can go into this program FinViz, go into Screener, and you can actually screen for, we'll go to Technical Analysis, and you can screen for patterns that are bearish. So you can search for head and shoulders, up channels, which are a bearish pattern because you're looking for them to break downwards, descending triangles, upward wedges. There's a lot of things you can do here that will actually help you to where you can actually then start scanning for patterns. And, you know, just a really easy thing to do is obviously if you're looking for a short, you can add the ability to go and say, well, if I'm looking for a head and shoulders with a really high P to E ratio. So there we go. Let's have a pattern there. Let's look for a head and shoulders with a high P to E ratio. There's none. Okay. And again, you're going to find that this is a bit cumbersome. This is not the best program. There we go. So we remove it a little bit. You can see you start to get options of patterns. We could say if we're looking for a double top. Okay, let's look for a double top with a P to E ratio. Okay, let's sort them high to low. Okay, there we go. We've got Cube Smart as a double top. We'll click on charts, and there we go. We can start to see the patterns. There's a great example of what I was just showing you before. That beautiful, sharp atom and atom double top. Okay. So once you go in there, you can start to have some fun there with actually building out your ideas. Now, when you were building your ideas, obviously, you want to think about not, think about things that can be used all the time. You don't want to constantly be creating new scans. But what the most important thing to do is to make sure that you create consistency. Because with anything that you do in the stock market, there's always going to be some level of luck involved. But if you talk to poker, look at the World Series poker, you can have hundreds of thousands of people compete. But at the end, there's always the same people at the final table. Always the same traders making the money and the same types of people losing. Why? Because winning in a game where there's an element of risk requires systems. It requires consistency and structure. As with poker, to know how much is worth risking for how much reward. What are the high probability cards to play? If you have an ace and a 2 unsuited, well, maybe you give it a shot. But if you've got a 6 and a 2 unsuited, you better throw that garbage away, right? The stock market is absolutely no different to that because it is a game of probabilities that you can win if you know them. To know that when you're looking at a chart, do you have 2 aces in your hand or 6-2 offsuit? What is the hand you're dealt with a chart pattern? And the beauty about chart patterns is that if you know what aces looks like, as we said, we can scan for it. So what we want to do is we become, the best type of trader we can be is to create, it's to not trade all 100 patterns, to not try and trade every stock every day, all day long, to simply identify what is the highest probability type of criteria when they occur and wait for that. So we might not trade for 2 or 3 days, and then we'll trade 10 trades in that next day. Wait for the absolute highest opportunities to where and scan for them. That way we have we don't have constantly changing variables. If we're using the same strategy again and again, then we're using the same rules for how we get in and how we get out, so that we have a systematic way of trading. And then we have efficiency. The 4-hour work week talks about this throughout the whole book. Talks about the definition of wealth. It says, who's wealthier, the guy making 100 grand a year working 60 hours, or the person making 60 grand a year working 10 hours? And I would argue it's the latter. I would agree with Tim Ferriss. So who's the better trader? The person who has to spend 6 hours a day making 10% on equity return, or the person that's spending 30 to 40 minutes a day making 6 to 8%. I'm more than happy to take 20% less profits a month to gain 800% more time. Wouldn't you? And then of course, if you get into options and day trading, you're making tons more. Now, I'm not saying that there's anything wrong with sitting in front of the computer and watching it, but watch it in the higher probability hours. The best times to day trade is obviously the first couple of hours and the last 1 hour, or even hour and a half if you want to go that much. The low probability trading hours is through all the middle of the day. So why trade it? I guess the whole point here is that we can create systems in this world of technology to do the jobs for us if we know what we're waiting for. And that's where scanning comes into play. And that's why I'm not a day trader or a swing trade. It's because 80% of the trades that I do that are day trades, I'm nowhere near the computer screen. Because I've looked at the chart setup, like something like NUGT. I've programmed, if the stock does this, then do this, based on rules. And I can plug in my trades and let the computer do the job while I go and enjoy myself or do whatever I want to do, working on other things. That's what scanning gives us the capability to do. So, what's this all leading up to? What are the next steps? What's my big sales pitch at the end? Well, the market opportunities right now are excellent. We have an amazing amount of volatility, and volatility doesn't mean danger. When we saw to me anyway, in 2008, as I showed you earlier, the market fell very fast and recovered very fast. But the actual trades and the patterns that we traded were no different to what we would trade in 2010 and 11. They were the exact same entries, exact same exits, exact same patterns, same stop losses. It's just that the market was on fast forward and they took 3 times, 4 times, 5 times faster to occur. And when if you have a system, and you can turn your system that makes you money on 5 times faster, that's excellent. And that's why these markets are fantastic at the moment. Now, with the course we're offering, it's 4 lessons. It's as you can see, we were meant to do an hour talk tonight, and we've been going for an hour and a half. So we don't do anything by half standards. If we're going to teach you something, we want you to have all the information available to you to learn it properly, so they're not to be missing pieces in your foundation. So you're not sitting there saying, yeah, well, I understand John's telling me to do this, but I don't understand why. Therefore, you have no confidence in it. So this workshop is all about scanning. And what you'll learn in this course is an overview of all the smart money patterns that basically are out there, and the ones that we look for and specialize in, and why they are the highest ranking in all market conditions. We go through the core characteristics of the highest probability patterns and how we identify scientifically, with a process, not guesswork, not just drawing trend lines randomly on the screen, not knowing if they're right or wrong. How do we draw the correct trend line to know what the correct pattern is, and then what is the rules to trade it? And then how to incorporate everything we talked about tonight with the smart money indicator, load it into your platform, and start using all the key things that we look for. Yes, it is only 97 for the whole course, not 97 per lesson. Each lesson is about 2 hours long. And one of the key things that we will be going through in this course is teaching you the capturing the crash scan. Now we are in. If we go bullish, well then we'll look for bullish trades. But one of the most valuable scans you'll learn out of this is a scan you can click one button in your trading platform. We've got it designed in most of the mainstream patterns. We also have it programmed on free platforms you can download if you don't have scanning software. And all you do is click one button each night, and it will find you the stocks that have the highest probability setups with all of what I discussed going on. The insiders selling, institutions selling, smart money selling, the pattern breaking down, and basically going through how to find the stocks that are going to be the most susceptible to potentially significant drops over the next little while. And if the market does break down after March 1st, then we've got a several hundred-point drop below us to the 1600 level. That's where we make. If you're an options trader, that's where you can make 300, 400, 500% in a very short period of time, potentially. If it's an option trader, if you're a stock trader, this is where we start to position ourselves in stocks that we're not just looking for an 8% return. We're looking at 20, 30, 40% runs. Will they be recorded? Actually, you get these instantly. So once you enroll there at the tradethirsty.com/wealth, you will get them immediately, so you can start actually going through them and learning them and learning the strategy right away. We're obviously, it's a time-sensitive moment here because the March 1st is right around the corner, and especially when we're looking at capturing the crash or going long, we've got a very key window here where we've got big opportunities. One of the things that we're going to be including for you, which will just help get you over that hurdle of soaking this up quickly, is we'll also be sending you out a video tonight, which will actually summarize all of the, as well as an email, summarizing any positions that we're looking to trade tomorrow, what pattern they are, why we're getting into them, entry, exit, stop losses, options, obviously the full breakdown of everything I've talked about, but basically the research done for you. And we'll be showing you what we're looking to trade for the next day, and also a summary of all the current positions that we're in, that we've entered over the last few days, or maybe looking to enter in the next few days. And you'll get that tonight. So the other thing we'll be following that up with is a live class tomorrow. So the live class will be at 7 p.m. Eastern, same time as we started tonight. Will be recorded for you if you can't make it. We'll be going for about an hour to an hour and a half, where all we'll be talking about is the current market conditions, and then running the scans, and then picking out the trades that we're going to look to take for the next day, discussing the entries, exits, and any updates on existing positions we've already talked about. Okay. Oh yeah, do we discuss the best type of trade for the pattern? Well, absolutely. If we didn't do that, then the pattern would be useless. Yeah, I mean, it's about connecting all the dots. So it's okay. So what type of market are we in? Okay. So what type of scan do we run? Okay. Now, once we know what type of scan we run, then we get our list of, say, 10 stocks. We'll look through those 10 stocks and say, right, well, and know exactly what type of criteria, what we're looking to see on the chart when it pops up. And then out of those 10, we might be left with 3. And then we're going to teach you what to look for from those 3 stocks. And whichever stock, and maybe all of them, maybe none of them, meet those rules, those are your trades. So yeah, and then once you know the trade, the rest is easy. I mean, where to actually enter, exit, and get out should never be a guessing game. It should be dictated by the rules. That's what 80% of the market works on, is rules. So why not trade like those guys instead of competing with them? So this is, yes, now, if you are, I'll put some reviews up here while I talk about the other option you have. If you want to continue on with those, there's a few questions about that. Yeah, you will be given the option. It's $9. You can add it on, and you actually get the live classes for a full month. So Tuesday and Thursday every week for a month. It's an extra $9. And that also includes for you our executive summary service, which is where we send out a video, basically, almost every night. Not every night do we have trades, but every night we have trades we're going to get into for the next day, will send you a video saying, hey, these are the stocks we're going to buy tomorrow, entry, exit, stop loss, and the options. This is actually an email from one of our students today from the alerts we sent out. Well, what day was that? February 22nd? Yeah, 2 days ago. So we sent out an alert. No, sorry, Friday. This was Friday's summary. So on Friday night, Thursday night, we sent out an email to all of our subscribers saying that ABCO was reporting earnings, and we expected it to plummet. And so Jay, I'm blacked out his last name, obviously. So you see down the bottom, that was his first email to me. Closed ABCO trade out with $7,035 profit. What puts did you buy? What percentage return? Bought them for $370. Sold them this morning for $13.90. 276% profit in 2 days. This is the reason why we picked this. It was everything I've just talked to you about, all put together. You know, so we look at the. I'll just go to the a fresh chart. Okay. So what did we have? We had a stock that had broken key support. How do we know it was key support? It was a very sharp, aggressive rally. We can see that it came down there and the volume went up 50% from 221,000 to 316,000 as it broke that support level. That then accelerated to 500, 600,000, 400,000 as it started to drop. This was ahead of earnings. Now let's go back to our indicator, our smart money indicator. What do you see from the smart money? I can take all this other stuff off there just to make it a bit clearer for you. What do you see the smart money doing ahead of earnings? Getting the hell out. It broke the 50% Fibonacci 2 days ahead of earnings, and that was why we alerted as an earning options during earnings play to get some very speculative cheap options, expecting this to plummet, and it dropped 43% this morning, and that was the reason why. Now there's another one I'm holding actually right now as a speculative options play. Carter's Incorporated, a report in the morning. Same thing, head and shoulders, rallied up into resistance, just sitting down on that shelf of support. Money flow is divergent. Insiders are selling. Now I could lose on this one, but this again, it meets my rules for taking the trade. So whether I'm right or wrong, I would repeat it 1,000 times over again. But anyway, that's the kind of alerts that we send out. The link, yes, sorry, I'll bring that back up. Some more emails here. Let me just try and skip past this. Yeah, well, the results have been awesome. I mean, we've had people just without trading aggressive options since the crash began, up 45% to 390%. There's a link again. Tradethirsty.com/wealth. Tradethirsty.com/wealth. Okay, just 1 second here. Just had to make a correction. There was a The wrong link down on screen. Yeah, tradetester.com/wealth. Have any questions that I didn't cover? Well, we'll break into live charts here now, and we can chat. Looks like a lot of people still here, so we'll obviously make sure we answer any questions that are left outstanding. So yeah, the sessions are always on Thursdays. No, Tuesdays and Thursdays, and but always at 7 p.m. So I want to watch this recorded video again. Where can I watch it? You get emailed these straight away, so you can watch them as many times as you like, and you'll have access to our membership portal where you can log in and watch those. Did he hold options during earnings overnight? Yes, so that's what the trade was. Now, we'll never hold stock into earnings overnight, but we'll always hold options. So, I mean, I'll refer back to actually his email earlier. That was the other thing he was talking about. So here, sold MYCC, holding March 12 calls. So last night, we sent out an alert that if MYCC opened at support, we would be going long as a day trade. But they reported earnings after market today. So this morning, in the wee hours of the morning, I sent out a text message and email alert to all of our students confirming what we talked about last night, that I was indeed going to buy MYCC as a day trade, but also go and buy some March $12 calls. Now, they reported after market today. We bought the, I think the March 12, 25 cents. The stock was at 11.30. So I figured that considering look at the money flow shooting up. Now this is a momentum pattern. Look at how the stock hugs the moving averages, and then suddenly, pop, goes from 388,000 shares to 795,000 shares as it breaks the moving averages, and then pop through the next resistance, goes from 465,000 shares to 967,000 shares. Money flow shoots up, and so this is why that was a day trade. A day trade to buy at support as it touched its moving average today. Obviously a sell before it closed after market. Recorded a record year, and earnings were good. So given the pattern, then this should continue up. My target's I think 12.77, just off the top of my head, is where I'm looking to exit those options. So if we get a move from 11.38 to 12.77, that's about another $1.50 on top of a 30-cent option. That would be a 500% return. So that's the kind of trades we're looking for. Okay. Now these do not trade after hours. As far as I'm aware, I couldn't see them trading after hours. So there's been no reaction yet to the earnings. We'll see that tomorrow. Is your system based on seasonality? No. The system is not based on any kind of seasonality at all, because let me ask you this way, chicken and the egg. If, let's say that April is a really bad year for copper, now I could go and form that opinion and say, well, April's a bad year for copper, therefore I'm going to short copper. But if I'm shorting a chart pattern that's bullish, and even though seasonality would say that I should be shorting it, let's say that something's going on in the world that's making the smart money load up on it, am I going to make money or lose money? I'm going to lose money. So ultimately, if, let's say the seasonality was true, let's say that copper was really weak in April, and April comes around, and because of seasonality, the smart money knows this. They know the seasonality a hell of a lot better than I do. They start selling off. What's that going to mean? That's going to mean that the chart's going to be bearish. There'll be a bearish pattern, because that's how the market works. Show me your stock. Show me any stock. I'll show you the pattern. We'll do that in a second if you like. And we're going to see the money flow dropping. We're going to see the insiders potentially selling, institutions getting out to get back in at a better price. We're going to see those things. Now, I might not know anything about seasonality, but what I'll see is those who do selling. And so that's what I find more important is what we're trying to monitor here is not trying to be pseudo-economists and figure out where the world's going in the next 5 years. That's not my job. That's not what I'm good at. What we're good at is understanding market structure and knowing how to detect those who do know that, what they're doing with their money, and reacting to that or anticipating that. Are the trade alerts part of the $97? That's the add-on for $9, and then after the month you get for the $9, you can continue on with trade alerts from anywhere from $50 to $150 a month, depending on how much ongoing coaching you want. Whether you want live coaching sessions, one-on-one coaching sessions, all those types of things. And so you can really decide, you get everything over the month, and then you can decide which pieces you like. Or if you just want to give it up entirely, you just cancel at the end of the month. But given the month we're about to probably have, I'd be very surprised. But one thing is, whatever you do with our service, you use it. Watch the training, follow the alerts, because we've had months, October through December, where we've had pick after pick after pick of like option trades do 300, 400, 500%, and people would cancel because they hadn't been watching any of them. So please, if you're going to take the trial, please watch it. Don't take 20 trials at once. Take a few that you like, a few coaches that you like to listen to, and follow them so you can really get your, even though it's not only $9, so you still get your money's worth. What do I see for Apple? Okay, AAPP. Let's get into the charts here. I'll leave the link up on the screen. Oh, there you go. Okay, what do I see for Apple? What do the rules tell me for Apple? The rules tell me for Apple that we are, why isn't it working here? By the way, Apple was something we picked as a short back in November, but right now we can see that it's been listening to moving averages, so it's been downward momentum. We had an upward break of this level. We filled the gap. You can see that the gap resistance is what we've run into right there. And we've pulled back from that. Now, the question is, will this trend line hold? So what we're dealing with now appears to be a bit of oscillation coming out of this momentum break. I'd probably say that there's better trades in Apple at the moment. Yeah, I think that's too much noise. I think that it's obviously at support. There was good volume today, but I think that's a messy chart. There's probably much better ones than that you can trade. DDD. Yeah, this is actually one that I've liked for a while. This is one I was looking to actually go long back in December, and then it broke down, and so I decided not to. But then when it broke out, once again back here, again look at the smart money. You have the stock basically going nowhere, and look at the comparative level. Look at the here we go. So when you start to break through right there, when that breaks through zero, what's the price of DDD? $9. What was the price over here? $10.80. Smart money was at -11. Smart money's now 12% higher at 10% lower price, or 20% lower price. There's also a lot of insider buying going on with DDD. So yeah, DDD is one that I like as a long. FXE, and that's a momentum trade too. You can see it bouncing off its moving averages. FXE, Euro Trust, nope, I'd be short that as soon as if it broke the 9-day moving average. We've got to be careful about a possible head and shoulders though. I mean, we're looking at that trend line support. No, I would wait for that trend line to be broken. There we go. What is wrong with this trend line here? Okay. So you can see we've kind of got this convergence cross. So I would say that I definitely want to be clear of this kind of round of resistance. Keep in mind that you have positive money flow and it's supported by an uptrend. So I wouldn't be long because again, I think it's better long trade. It's underneath the moving averages. Moving averages trump oscillation, but we've also got two levels of oscillation here and positive money flow. So what we want to see is a perfect storm. That the whole title of today's webinar, the perfect storm, as you'll see when you go in to purchase the course. The perfect storm is, wouldn't you prefer to see this underneath that line, and wouldn't you prefer to see the money flow there? Wouldn't that make you feel more comfortable if you saw that chart? So my question would be, I would much prefer to short this than that, and I'd much prefer to go long if I saw the stock making a nice bullish close above the moving average like that. I mean, look, these are the kind of stocks that are doing really, really well. Have a look at B-Box, another like kind of the smaller stock that I picked up a long while back. Just look at the way this stock's performed. Again, long downtrend, very sharp money flow divergence, very much dictated by its moving averages, so we know it's a momentum trade. Broke through its momentum trade right there, and then bang, just rallied from 7 now all the way up to almost $14. The stock alone up 100%, and that was, and you could see that in that massive amount of accumulation of smart money from the very early days, from the 17th of December on. All it did was drop, and all the smart money did the whole way down was buy. TRGP, another one that we had picked out as buying calls on just a few days ago. This one looks great. I mean, you can see again the smart money loading up as the stock drops. The stock has been in a downward channel. Okay, downward channels are bullish. It's also been compressed by its moving averages, and it just started to overcome those. That 20-day moving average, the key thing that was holding it back, every single time it rallied, it overcame just a couple days ago. So that was one that we had alerted as something to buy calls on. I think it was the $25 calls, and that's got a nice potential move to rally up to its 22.3 Fibonacci. The money flow certainly says so. There's insider buying. These are the kind of ones I want. Let's have a look. CMG. CMG is actually one that we had alerted people to pick up 440 calls on. No, 450 calls on, I think it was, when it was here. That was the day of the alert. It took a little bit to come by, but this is actually one of those patterns I was telling you about before. It's that fallen angel pattern. So you can see that the oscillation. I'm drawing it roughly here, but the oscillation, and then you get that nice spoon at the bottom, turns into momentum, and there you go, pop. There's your entry point. We said the 450 calls. It should be able to rally to at least this level, and then possibly higher. And so there we go. And it rallied up into the top of that that handle, and then boom, off it went. So that's actually something we'd already alerted people to back on Thursday, January 14th. Is the Twigs money flow indicator available on Think or Swim? Yes. In fact, the Twigs money flow will come as part of your package. It's been already pre-packaged and ready to go for TC2000, Metastock, Think or Swim, TradeStation. What else am I forgetting? TC2000, by the way, is of course the same as free stock charts. Twitter. Yeah, I'm not a big fan of the Twitter. I mean, we saw what happened to LinkedIn. It's obviously pounded the stock down. It's under significant resistance, but there's nothing bullish about the candles we've seen, and the stock was unable to make a new high today, despite the sharp reaction in the market. So, I mean, it's a bit too speculative for me. I think it's not whether there could be a trade. Certainly, if it crossed its 50-day moving average, I'd be friendly towards it. The money flow is in its direction, but again, the question is it the best trade? So I don't really care what the company does. I care, is it the highest probability trade I could have? And I could draw this chart better to make me feel better about that as a long. CUDA. I actually own calls in CUDA. I bought calls in CUDA back when it started to rally up to its moving averages. This is a possible buyout story. It just keeps nudging higher and higher. You can see I've got my trend lines already drawn on this. That's what it needs to overcome. There's probably better trades. I bought the options because it's a speculative trade. It's the kind of thing that that'll rally to 16 or will do nothing. The main threat ahead is this trend line and this moving average. If it can overcome that, it's got a good chance of filling the gap up to $16. Where do you sign up? Just the link down the bottom, tradethirsty.com/wealth. Can we look at bonds, TLT? Well, let me show you the more important bonds to look at. Firstly, HYG, corporate high yield bonds. This is the one to watch when dictating where the market's going to go next. Ever since the introduction of heavy quantitative easing in 2013, quantitative bonds have been dropping sharply. That means that smart money has not been investing into corporate America. So if smart money has been sharply selling corporate high yield bonds off since then, but the market has continued to rally, that is another sign of massive divergence between the true story of what smart money thinks and what the speculative investor thinks about the stock market, or manipulation, inflated values, blah, 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 blah. So corporate high yield bonds are the ones to watch, because corporate high yield bonds should move if the market represents true value of what smart money thinks. Corporate high yield bonds should match. As you can see, they plummeted with the market, they rallied back with the market. But since, again, around 2013, 2012, they've moved the opposite. That tells you warning signs. Now, right now, the corporate high yield bonds are moving with the market, but we've also got an expanding range channel, which is bearish, and the 50-day moving average over the top. So whether we have a breakout here, this is why we're in such an awesome time. I mean, whether we go heavily long or heavily short, we're going to probably know within about 3 or 4 days. And that's why this is one of the best times for you guys to involve. We did a webinar on predicting the market would crash at the end of July, and people waited. You know, they put it off for a month because they were busy and things like that. They missed out on massive profits. Now, it may not happen, but the probability of something huge happening within the next week is high. And we've got scans ready and positioned and things we've worked on for the last 10 years for the specific focus, and this is what you'll learn in the course, of course, is of finding what's ready to go long or short on right away. Now, corporate high yield bonds break through 79 on volume, then as well as market open range breaking higher on March 1st, then this correction is quite likely over for at least another maybe another month. And if they continue higher, then it's back to the after party of buying stocks again. You know, so how far out do you buy options? If I'm trading earnings, I will buy options that expire the very next day if I can, because I want to basically I'm willing to, but I'll put a very small amount of money in. So what I'll say is, okay, the stock is going to have a dramatic move one way or the other, most likely. Let's say that I was willing to put $10,000 into a stock investment, but I was only willing to risk 3%. So I was only willing to lose $300 of that $10,000 before I said, right, it didn't bounce off support, it's broken it, get out with that $300 loss. Well, if I'm going to be going into an earnings announcement, then the stock could gap up 20%, and I could lose all of what I put into that option. It would become worthless. Therefore, how much would I put into the option? How much am I willing to risk? That same $300. So if I'm going into an unknown move to a height with a potentially high percentage probability could go up or down 20%, then I'm going to only put in a very small amount, because if it does have a surprise and drop 30% or 40%, then my return could be 300, 400, 500, 600%. If you bought puts in LinkedIn, you would have made something like 16,000% overnight on the short-term puts. Now, so the key is capital management and only putting a small amount of money in what you're willing to lose all of in a 24-hour period. That's how I play options during earnings. If I'm buying a position in buying options to leverage the move of the stock, I'm typically buying out-of-the-money options that are about 3 to 6 months out. So, for example, CLI was one of the ones we actually bought puts in back in December. And again, you can see the same kind of story. You'll see it again and again. You had the head and shoulders pattern. There you go, head and shoulders. Left shoulder, head, right shoulder. So as it rallied up into that right shoulder, we bought the $22.50 April puts back in December, and actually just about $2.50 puts, April expiration, and wrote it down. So extra to the order, you'll be given if you put the form through. Just click. It'll say, do you want to add? It'll give you different options that you can add to it if you want, depending on if you need to. I'm not sure how it comes up, but it should just have the options on your screen, and you say yes, thanks, or no, skip this, or whatever the case might be. Will come up on the screen right afterwards. Sorry, Rich, I missed the context of the question. Can you flip that around? How would you know? If you can remind me of the context of what we were talking about when you asked that, I will cover that. I'll get to the next question. I'm a futures trader. Will I have enough time within the next week to absorb enough? Of course, yes. Yeah. I mean, the core information, it comes in the very first lesson. So if you've got a lot of other things on the go, then this is actually, when this course started out, what you're learning here was it was actually only the first lesson that we sold for $97. The first lesson out of 4, but we had it was very exciting markets, and it was we had an excellent group of people that were very good friends of a couple of the other coaches I've worked with in the past. They were all students of his that he'd referred to us. So we wanted to look after them. So we decided to turn the course from a 2-hour, 1-lesson course into we did another lesson, and then we did another one, and then we did another one. So in fact, the 3 lessons in the latter part of the course were actually all bonus lessons that we decided to add to just give amazing value to these students who were the first takers of the course. So in actual fact, the core information about the scanning and how we're looking for the highest probability stocks to crash is all in that first lesson. What comes in the follow-up lessons is all about how to get into the high probability patterns, going into open range. The scanning and execution of the strategy itself was always intended to be in that first lesson. The extra 3 were just ones we had decided to add to make the course just that much more awesome. The dates and times of classes is every Tuesday, Thursday at 4 p.m. Pacific, 7 p.m. Eastern. Okay. TLT, yeah, I promised I'd have a look at that. Are they all voided if you miss one? No, you have. You can attend they go for the whole month, and they go every month. So I mean, there's 8 a month. If you miss one, then you simply join the next one. But they're all recorded as well. So if you miss one of the Tuesday, Thursday sessions, then you receive the recording that night. How do you sign up? Just go to tradethirsty.com/wealth. The link should be on the bottom of the screen. I'm trying to keep it on the screen, but hopefully that's displaying correctly on everyone else's. TLT is something that looks a bit toppy to me. I mean, bonds are being touted a lot at the moment because people say, well, do we go to gold? Do we go to bonds? Or what do we do? I mean, the bond market, and I wouldn't be making any big moves until after the 1st of March. I'll put it that way. I mean, there's every possibility that what we're simply seeing over this week is a very well orchestrated short squeeze. And just remember that the rallies in bear markets are always far more dramatic and painful than rallies in bull markets, because they're designed to make you do the absolute worst thing at the worst time. Now, that might not be the case. Maybe we have recovered. Maybe the Fed and the Federal Plunge Protection Team are that powerful and that dedicated to propping this market up that they'll keep it up for another month. It's possible, but eventually there's very big problems to address. Could they be addressed? Who knows? But that's why we don't try to guess. We just follow the rules, and the rules tell us we've got a couple days left until we hit major time resistance, which is open range. Then we have 3 weeks of high probability trades until the next range is set. So why would I go making big investments in one direction or the other when I can have 80% probability on my side by waiting 3 days more? That would seem nuts, doesn't it? Imagine if you were sitting there and playing a card game. I'll just use card game for example, because my partner and she loves to play cards, so every night we'll share a glass of wine and play cards together, and chess actually. But anyway, so imagine if you were sitting there playing cards, and someone came over and said, "Hey, buddy, just hold on a second. One of my friends is coming, and he knows this game really well. He wins 80% of the time every time, and he can show you the track record to prove it. And he was going to be there in 5 minutes. Would you wait, or would you keep betting all your money on the table before he got there?" You wouldn't. You'd wait, wouldn't you? I'd hope you would. Otherwise, I want to play cards with you. So when we know that, and you'll get this through the course, when you go back and look at the history of open range, it is like almost over 80% successful in predicting the next move in the market. When we're so close to finding out what that next move is, why blow it on taking unknown risk to any large extent so close to that day, I guess is my point. So now when we get high probability trades like NYCC, where the pattern is just so strong, or short-term trades that we intend to exit before open range, totally different. So, you know, there's other ones we're looking at. Excuse me. This is a great example. Very, very strong. So G20 meeting in the next few days. There's shorts on edge too. Absolutely. Does open range have to happen in a few days? Open range will always happen on, the open range will always happen on the 1st of the month and the 3rd Friday. However, that doesn't mean it will be broken the very next day. In fact, it could go sideways for 2 or 3 days until a break occurs. So the open range will definitely happen on March 1st, but whether we find out it breaks open range the next day or not is what time will tell. flow of funds out of corporations, can that flip? Yes, it can. And if we saw the high yield bonds suddenly start to rally strongly, that would signal that there's something going on that we don't yet know about. That is yet to come. GLD. Yeah, we've been long gold for a long time, but it's topping out. I mean, I wouldn't chase it here myself. I mean, there's obviously the technical strength behind this is that it's got a pennant formation, possibly a flag, which would dictate a further move on GLD to 125. If you were going to technically trade that, that means it's right at support. We may get a further move down, as we saw on NUGT, and we charted that earlier. The problem is we've made a lot of money on NUGT and gold already. This is one of the other alerts we sent out recently was on actually Rand gold. We actually sent out. We discussed this in our trading room as a buy on, I think it was Tuesday, January 19th. It was either the 19th or it was the 21st, being the Tuesday, Thursday. Either way, we had alerted people to the $75 March calls, and those just, I think they went from 180 something to $16, $17, possibly more. I mean, there's just a lot of money's already been made here, and what we really want to be doing is finding the next stock that looks like that, right? Not the one that's already there. That's what scanning's about. Why find that when we could find this? Because how we found NUGT was by doing a scan. That's the only reason I was looking at gold. I don't trade gold, I don't trade copper, I don't trade the stock market. I trade highly profitable patterns. And I don't care what it is, whether it's my own father's company. If it doesn't meet the rules, I won't trade it unless I'm being stupid. And I have been known to make mistakes. As we all do, we're all human. We all like to have a gamble here and there. And I've taken a couple of gambles here and there. I have a long winning streak, and you feel you had the touch of God, and you take a bit of your winnings and do a silly bet on something, or put too much into an earnings play. We all make those mistakes. But fine, have your fun. The core of your trading should be focused on trading the highly profitable patterns with strict trade management rules. Do I watch open range on each stock or just on the indexes? Open range does actually work on stocks as well, especially the first half an hour of the trading day is open range for stocks of every day. And but no, I look at the index because I don't believe that it is a stock market. I believe it's a market of individual stocks. And on every day, almost every day, no matter what I believe about the market, I will always take opposite trades. So I might pick up 3 or 4 short positions because I think the market's going to plummet. But then I'll find on my long scan, because I'll still run my long scan each night, but then I'll find on my long scan a stock that looks perfect. That looks exactly what I'm looking for a very high probability long. And even if I think the market's going to plummet, if I find a stock that meets all the rules and it's absolutely perfectly formed in a pattern that I trade that you'll learn, then I'll buy it. And I believe that a good trader should be able to make money going long in a short market and make money going short in a bull market. If you have good technical analysis, there will always be stocks going down and there will always be stocks going up. If you scan for the high probability patterns for either direction, you should be able to make money regardless of market direction. It just helps if you're going with market direction because there's more stocks going that way. Does that make sense to everybody? But I will always take hedges. I will always be looking for longs and shorts. I'm looking for the best shorts and the best longs. You know, if I think the market's going to plummet, I'll take 6 shorts and 4 longs. If I think it's going to rally, I'll take 6 or 7 longs and 3 shorts. You get my gist. Okay. Can I look at ECA? Sure. Yep. Yeah, I keep an eye on that. I mean, again, there's a lot of stocks that look like this, but you know, if you actually break down a smaller time frame, I wonder if we've got a slight head and shoulder form there. I may just be being paranoid, but let's strip the noise for a second. Okay. So we've got a breakdown there. Okay. Okay. So it's not clear to me. I mean, I think that there's a potential for a flag formation that may be occurring here on Encana. You can see that the way that that's forming up, and you've got equal tops, and you've got rising bottoms, which makes an ascending triangle. If we look at how much volume came in, that confirms the flag. So you've got a breakout from that level there. Yeah, I would probably take a shot at this. I'd want it to break 370, and then I'd be looking at a target. There we go. There's the extension from 370 to 430, which is exactly where it runs into the previous trend line. So I mean, you've probably got about a 60-cent potential gain. If you got in say 374 to let it break, and then I would be exiting. Let's just have a look at where that rally matches up with anything else. Yep. So there's the high of that candle at 433. So I'd be going down to the low of that support. So my target would be 417. And that would be a flag play. So what I would do, for example, this could potentially be a day trade, but where I go in is I'd say, okay, buy stop at 373, sell limit at 427, right? And stop loss down below of the wherever the reversal candle was. So I mean, we've got 60 cents of potential profit. We can afford to risk 20 cents. So we could have a stop loss at 350 and still be maintaining a 2-to-1 risk-reward ratio and give it ample room to move. So that just gives you an example of, and now I don't have to sit there, I don't have to watch it. I wouldn't watch it. I'd plug it in and I'd forget about it until it hits either my stop loss or my target. And then I do 3 other trades like that, and let it either hit, either play out or not. And as long as one of them works, I haven't lost any money. So with this trade, I mean, you could actually go a little bit tighter. You could probably go there 357. So now you're taking 7 cents less risk, which means 7 cents more reward. So the risk-reward ratio now becomes more like 15 cents to 60 cents. Now you have 4-to-1 risk-reward ratio. Now you only have to get 1 right out of 4. Now if you can find a trade that has a 5-to-1, or hey, hell, let's look for a 10-to-1 risk-reward ratio trade where the actual rules give you the ability to have a 10-to-1 risk-to-reward ratio, then all you need to do is get half of your trades right, and you're making a lot of money. So again, that's why I keep telling you, don't worry about being right or wrong. You can be wrong 60% of the time and live off your trading. if you get your rules and your risk management right. So yeah, this trade would have the risk-reward ratio and looks good. What is this strategy called? This strategy would be a flag formation. TWOU has earnings tomorrow. Okay, let's have a look. Yeah, I mean, it favors the longs. You've got long-term price divergence going in your favor. You've got it held all kinds of support. It didn't break down beneath its moving averages. It just pulled back. It broke through. It's a momentum trade. The upside may be limited. You're probably looking at a rally to about 2097, possibly as much as 22. But that one looks good. Where's the horizontal? Ah, there's the resistance. So that's what it needs to break. So that would be powerful if it can break through that. CRM. CRM was actually an earnings play that we actually took it as an options play up here when it hit resistance at 64. It broke down, and as you can see, what happened just over the last day is money flow actually broke through positively to zero. Now they reported, so I was holding a bunch of, we actually alerted it to our students today as a put potential about a week ago. And so then ahead of earnings last night, we said, look, this is probably the kind of thing where we'll dramatically reduce our position because we're going into an unknown announcement. I did hold some puts in this into the earnings announcement still, because it was an earnings play, a valid earnings play, a lot of insider selling and so forth. But they reported after market. I think they were up about $5 or something, so up around 69. So they've gone up into resistance now. So those remaining puts I'll be holding, because if these guys get hit, if the market gets hit, they won't be. Then these guys are still going to get hit as well. And the thing about stocks that gap up big time, as soon as the market that have high P/E ratios, as soon as the market gets clobbered, guess where people sell? Guess what people are selling when they're getting margin calls because they've started to leverage themselves and they've already been short squeezed the week before. What people sell? They sell their profitable positions. And so in a bad market, when stocks gap up, I've seen many a time a stock gap up on excellent earnings and be down twice as much 3 days later. So I will continue to hold my puts in this one, and there you go. All right, so we'll finish up for the evening. We've gone well over time, but once again, that is how you get enrolled. It is tradethirsty.com/wealth. We had a great evening tonight working with all of you. I hope that it helped your trading and gave you an extra bit of edge. Again, the course is an excellent way to take it the next step, because it's a lot of work to sometimes put all of this together. And what these scans do is take all the key pieces that we're looking for in a stock selection and in a scan, and what forms the first step of almost every trade I do is to run one of my scans. So through this course, we'll teach you how to do that, how to build your scans, and of course how to start to trade them. So I'll leave that address up on the screen for a little while, and we'll look forward to seeing you all in tomorrow's class tomorrow night. Take care. Have a wonderful evening.